Hi everyone and welcome back to another video in my channel, Orderflow with Ethan. So my name is Ethan and I've been trading the orderflow footprint chart for roughly 4 years now, and throughout these years I have built great knowledge and understood how to trade using the footprint chart, and here am I on YouTube right now explaining it to you step by step. So welcome to the 17th section in this channel, trading using mean delta and maximum delta. So how do I use them? Mean and max delta show you extremes, the moment when sellers and buyers are most aggressive, and I don't treat it like a signal you can blindly follow. It's more like warning light. Something important just happened here. Knowing that, you can pay attention to how price reacts after the push, which is where the real opportunity shows up. Delta measures aggression, but mean and max delta show extremes, aka the strongest push in a move. A max delta spike tells you where buyers went all in, and the mean delta spike tells you where sellers tried their hardest. It doesn't tell you if the move will continue, just that someone committed heavily. That's important because these extremes often indicate either a continuation or a potential failure, depending on what happens next. So, most traders just watch overall delta and think they understand the market. But the extremes tell the real story. They show the moments where the most volume or aggression is concentrated, which usually coincide with the traps, absorption, or breakouts. If you ignore the mean and max delta, you're missing the moments when the market is about to make a decisive move. So, what's the first question I ask myself? Whenever I see a big or max or mean delta, I don't think about entering yet. The first question is simple. Did price actually move the way it should with that delta? For example, if sellers were aggressive with huge negative delta, but price barely drops, that is a big red flag. It's the first hint that someone might be absorbing orders or the move might fail. Sometimes, max or mean delta aligns perfectly with price movement. Big buying pushes prices up clean, or big selling pushes price down. And that is so normal. Nothing special here, and this is what most traders see and feel comfortable with. But the real edge comes when delta shows aggression and price doesn't behave as expected, and that's where traps and absorption happens. So the interesting moments are when delta is extreme, but price isn't moving much. Well, you think, oh, there should be a problem. Like imagine max delta showing huge buying at a resistance level and price just stalls. That tells you something is absorbing those buy orders. Or when delta shows heavy selling near support and price isn't dropping. That's absorption the other way. And these are the setups most traders completely miss. So let me try to give you an idea first, okay? So if you go to this candle here, well, you can see the delta at minus 172, but at one point delta was 137, then it went to minus 207. But what we can understand from context is that the price went up to 137, then went down to minus 207. So if you can calculate it, let me use the calculator first. 137, so I got it here. So minus 207 minus 132. So after the price went up by 132.7, not went up, but when the delta was at 137, someone sold 339 contracts difference. Like people still bought contracts, but the difference was minus 339, which is very, very high for this candle and for this volume, which represents roughly, let's say, this could be roughly, well, made a mistake, sorry. Oh yeah, so roughly 20%. Someone sold by difference 20% of the volume to make the candle go down. So if you understand it this way, like delta just shows you how the price went. So delta here went up to minus 154, but then went up by 17 contract difference in delta and got to minus 84. Same thing here, price went up to 213. So this is why you can understand why delta shouldn't be green when a candle is green. Well, yes, when we started this candle, it was went up to 213, but then kept going down by 150 contracts difference between buying and selling, and then it settled at 63. Same thing here, same thing everywhere. So here was at 23, that was the highest delta, and then the market kept going down 166, but then it's kind of ununderstandable how it still went up to minus 157. Okay, so that's how you can understand how the market simply works. If a delta here, for example, went up to 299, here went down by 130 contract difference to 173. It's kind of complicated, but trust me, with time you're going to understand this context, because Once you understand it, you will understand a lot about how delta works, and you can understand the market context and the candle context and psychology or behavior, whatever you can call it. So most traders react to delta itself. Big buying, they buy. Big selling, they sell. They don't wait to see if the move actually works, and that's why people keep losing. They see aggression and assume strength, but price is telling a different story. Mean and max delta are just hints. The confirmation comes from how price reacts. So I watch, I wait, I look for the reaction. After extreme delta, does price continue in the same direction or does it stall and shift? And that is the signal I care about. I don't care about delta alone, I care about what it triggers, how price behaves after it, and whether it aligns with other contexts like support, resistance, or imbalances. So, delta extremes are much more useful when combined with other contexts, support and resistance, previous high lows, order blocks, and imbalances. And if delta spikes at a level that matters, that's when the signal becomes meaningful. Otherwise, it's just numbers moving in the background. So here's a simple rule I follow. Strong delta with price moving, that's likely a continuation. Strong delta with little to no movement, that's a potential trap you should be cautious of. So that's it. You don't need fancy indicators. You just watch if the market is reacting the way it should be. So using min and max delta this way filters out the bad trades. So you stop chasing moves that look strong but are weak in reality, and you start seeing traps before they catch you. And this is what separates people who just follow the charts from people who can read the market in real time. So thank you so much for your time watching this video once again, and I hope to see you guys in the next video. I'm going to talk about an interesting subject. So thank you so much, and please, if you have any questions, do let me know in the comment section. If not, just at least subscribe and like this video. So this was Ethan from Orderflow with Ethan, and have a great day. Thank you so much.